So, you are thinking about stepping into the world of investing. You have saved up some money. It's not exactly enough to buy a house, but you know it could be working harder for you. You could dive into stocks, bonds, real estate, or even that mysterious world of cryptocurrency and NFTs. There's no shortage of options, but the whole thing feels like a maze of choices. And to add to the noise, you've probably been bombarded by those YouTube art gurus promising quick riches through day trading or forex. Yeah, it's overwhelming. And let's be real, the fear of losing your hard-earned cash looms large. But don't sweat it. This video is your ultimate guide, your roadmap through the intimidating jungle of beginner investing. And here's the deal. We're going to break this down into 4 simple parts. Each section will be timestamped below, so feel free to skip ahead if you like, but I would recommend sticking around for the whole ride. The first part will dive into the basics and foundational mindset behind investing. Part 2 will explore how and why you should invest in stocks and shares. Part 3, that's where we tackle your deepest fears. What if I lose it all? And finally, in Part 4, we'll peek into the first lane of wealth building strategies that offer an alternative to the traditional, slower methods of investing. So, where do we even begin with this whole investing thing? Well, the core idea is simple. You want your money to make more money. Let's say you've hustled hard, saved up a cool $1,000, and now you're wondering what to do with it. Sure, you could hide it under your mattress or stash it away in a standard bank account. But here's the kicker. There's this silent wealth thief called inflation. You've heard about it on news, right? Your $1,000 could probably buy you a sleek new MacBook Air today. But fast forward a few years, and thanks to inflation, that same MacBook might cost you $1,200 or more. The reality, over time, your hard-earned cash loses its purchasing power unless you put it to work. So, the million-dollar question: how does investment actually combat inflation and grow your money? The philosophy is straightforward. You put your money into something now with the exception or expectation that it will multiply over time. Take, for example, buying a house. Not only can you rent it out for consistent income, but ideally, the value of the house also increases over the years. If you just left that same money to rot in a bank account, inflation would slowly eat it away. When you invest, you allow your money to actively work for you rather than passively losing value. Now, houses are easy to understand. Rent equals cash flow. But for many other investments, the equation isn't as clear. Stocks, bonds, even watches, and fine art, these things don't pay out like rental income. You're often betting on their value increasing over time. The big exception, stocks and shares, which we'll cover more in a bit. But before you jump in, you've probably heard of a bunch of asset classes like hedge funds, index funds, bonds, government, and corporate. And, of course, the new kids on the block, crypto and NFTs. All these sound super complex, right? Let's simplify it. For the sake of keeping things digestible, we'll focus on stocks and shares because that's the kind of investment most people like you and me, can easily get into without the need of huge amounts of money or taking crazy risks. So, what's the deal with stocks and shares? When you buy shares in a company, say Apple, you are essentially buying a slice of that company. Imagine if you could hop on Apple's website and buy a literal chunk of the company. That's not how it works. Of course, you need a broker as the middleman. But once you're in, you now own a small part of Apple. Now, how do you make money from this? There are 2 main ways. First, the value of your shares may increase over time. If you buy Apple stock today, in 10 years, it could be worth a lot more. The second way is through dividends. Think of it as a company's way of sharing its profit with its shareholders. Certain companies, like British Telecom, pay out dividends. So, When you own a stock in a company like BT, you're not just crossing your fingers that the stock price goes up, you're also getting a piece of the company's profits regularly. Now, here's where it gets tricky. With hundreds of companies to choose from, how do you know which ones to invest in? Do you go all in on tech giants like Apple or Netflix? Or maybe diversify with energy companies like BP or fashion brands like Ralph Lauren? Everyone has an opinion, but I'm going to side with Warren Buffett. Yes, the investment legend, and tell you the same thing he recommends. Don't waste your time trying to pick individual stocks unless you're a full-time financial professional with access to deep insights. You're better off investing in index funds. So, what's an index fund? It's a basket of stocks designed to track a specific part of the market. Take the S&P 500, for example. It includes the 500 largest companies in the US, from Apple to Microsoft, Tesla to Amazon. If you invest in the S&P 500, your money is automatically spread across all 500 companies, giving you instant diversification. By putting your money into an index fund like this, you're essentially betting on the growth of the US economy. And here's the kicker. Studies show that most professional investors don't beat the market consistently. So, instead of trying to outsmart the market, why not just invest in the market? Now, I know what you're thinking. What if I lose everything? This fear of losing money is very real, and it holds a lot of people back from investing. But let's shift our perspective. Remember that inflation thing. By not investing, you are guaranteed to losing your purchasing power. On the flip side, history shows that the stock market tends to rise over time, despite occasional downturns. Over the long haul, investing in a broad index fund like the S&P 500 has been one of the most reliable ways to grow wealth. Sure, there are risks, but the bigger risk is doing nothing and watching your money slowly lose value. And finally, let's talk about a faster alternative route to building wealth. There are strategies beyond the traditional buy and hold method of investing. Maybe you've heard of concepts like fast lane investing. It's about seeking quicker but potentially riskier returns, whether that's through real estate flips, startups, or even niche markets like crypto or art. There is a whole world of opportunity out there. However, for most people just starting out, slow and steady tends to win the race. But hey, if you're open to calculated risks and willing to learn, the fast lane might just be your ticket to accelerated wealth building. Now that you are armed with all this knowledge, it's time to take the next step. Don't sit on the sidelines and watch your money lose value to inflation. Get in the game. Start with an index fund. Diversify your portfolio, and who knows, maybe you will even dip your toes into fast lane strategies down the road. But whatever you do, just start. If you are ready to dive in, I would recommend checking out some trusted platforms like Vanguard or Trading 212. They make the process simple, and they're the ones I use myself. So, what are you waiting for? Hit that like button, subscribe, and let's continue this journey together. If you have any questions, drop them in the comments below. Let's grow your wealth one smart investment at a time.